You ever wonder who really pulls the strings behind the silver market? It's not just banks, and it's not just investors. This is the gray ledger. And today we re-exposing the shadow war controlling silver and how it ties directly to the US debt, the Federal Reserve, and the weakening dollar. But before we dive in, make sure you hit like and subscribe. You don't want to miss the full story. Let's start with the basics. The US debt has been climbing for decades, but the pace now is staggering. Every year, trillions are added to a national tab that no one can fully pay off. That debt doesn't just sit quietly. It influences everything from interest rates to the dollar's value. And when the Fed moves, the market reacts, often before most people even notice. The Federal Reserve isn't just a bank. It's the central authority that sets monetary policy, and their decisions ripple across the globe. When they raise rates, borrowing costs climb, and the economy feels the squeeze. When they lower rates, it encourages spending but also increases money supply, which can weaken the dollar and a weaker dollar. That's where silver comes into play. Silver has historically been a hedge against a declining dollar. It's tangible, it's real, and unlike paper money, it can't be printed endlessly. Now, here's where things get murky. The silver market isn't as transparent as people think. Large institutions, sometimes referred to as shadow players, hold enormous positions. They influence price movements with precision. They buy, sell, and manipulate to protect other financial interests tied to the US debt and dollar stability. Imagine a game where the dice are loaded. Retail investors see price swings and think it's market chaos, but much of it is orchestrated. You see, the Fed's actions, US debt levels, and dollar weakness are all interconnected with this shadow market. Every time the Fed signals a rate change, these players adjust their positions first. By the time average investors react, it's already too late. But it's not just about silver. Gold, bonds, and even equities are affected because everything ties back to debt and currency stability. The Fed prints more money when debt gets too high, which can dilute the dollar. And as the dollar weakens, silver prices often rise, but the shadow players control the speed and timing of that rise. This is a war of information, timing, and access. Those in the know can profit. Those outside it often get caught on the wrong side of a trade. Let's break down the mechanisms. The US debt isn't uniform, it's held in different forms. Some are Treasury bonds, some are bills, and some are held abroad. Each type reacts differently to Fed moves. Foreign holders, like central banks, watch closely because the dollar affects their reserves. And when the dollar shows weakness, they may shift assets, indirectly impacting silver. Meanwhile, domestic institutions exploit every opportunity. They understand which triggers will cause retail panic and which moves will lift prices strategically. It's not illegal, but it's carefully engineered. This is why understanding the US debt numbers matters more than ever. Trillions of dollars in debt don't just vanish. Every new debt issuance, every deficit report affects market psychology and silver. It's a favorite tool for these shadow operators. It's liquid, it's volatile, and it's highly responsive to shifts in the Fed's stance and dollar strength. Retail traders see price swings and assume randomness. But the gray ledger knows the reality. These moves are coordinated, often with precise timing to maximize influence. And it's not always about profit in silver itself. Sometimes it's a hedge, sometimes a way to influence other markets. Every action in silver can ripple across commodities, equities, and even the bond market. You may have noticed sudden price jumps or drops that seem unexplainable. That's rarely random. It's the shadow war in motion. And now, more than ever, with record US debt and a Federal Reserve balancing on a knife edge, these movements are amplified. Understanding the link between debt, the Fed, and dollar weakness isn't optional, it's survival for anyone investing in silver or related markets. This isn't fear-mongering, it's insight. Knowing these dynamics can give you an edge that most investors lack. And that edge starts with awareness, not speculation. Before we go deeper, remember to like, subscribe, and turn on notifications. This series is designed to give you the full picture, the context other channels leave out. Because in this shadow war, knowledge is the real currency. And the more you understand, the less you're at the mercy of sudden, unexplained market swings. We'll soon explore the specific tactics used to manipulate silver. We'll also connect the dots between Fed announcements, US debt reports, and price shifts that happen almost in real time. If you're watching carefully, patterns emerge. Patterns that can guide smart, actionable decisions. And yes, there are real consequences for ignoring these signals. The dollar doesn't weaken in isolation, and silver doesn't spike in isolation. They're connected, intertwined, and often leveraged by the same players who influence debt policy and Fed moves. This is where the gray ledger provides insight that goes beyond mainstream reporting. We break it down into what actually matters for traders and investors. You see, it's easy to talk numbers. Trillions in debt, billions in silver positions. But the story is in the relationships between them. How debt levels push the Fed, how the Fed moves affect the dollar, and how the dollar moves set the stage for shadow market plays in silver. This is the chessboard, and we're revealing the pieces. By the end of this video, you'll understand the invisible hands guiding the market. And more importantly, you'll know where to pay attention for potential opportunities. Because in a market controlled by powerful players, awareness equals survival. If you're ready, stay with us. We're only getting started. And when we return, we'll break down the actual movements in silver over the past months, showing how debt, Fed signals, and dollar weakness align perfectly with shadow activity. It's a story of timing, strategy, and control that most investors never see. Let's dive deeper into the silver market and how it reacts to Fed moves. Silver isn't just a metal, it's a signal. When the Fed hints at lowering interest rates, silver often jumps before most investors notice. These moves aren't coincidences. They're reactions timed by shadow players who track every announcement. Even minor speeches or economic forecasts can trigger coordinated buying or selling. For example, a small comment about inflation can lead to millions of dollars moving in seconds. Retail traders see the price spike and think it's luck. Meanwhile, big players are executing strategies that have been planned for weeks. The correlation between silver and the dollar is key. A weak dollar makes silver more attractive, especially for international buyers. That's why you often see silver rise when the dollar index falls. But here's the twist. Shadow players manipulate both sides. They can sell into strength to keep prices low, or buy during weakness to push prices higher. This creates the illusion of random market volatility. It works because most investors don't understand the underlying debt and Fed connections. The US debt plays a silent role in all of this. Every new Treasury issuance slightly dilutes the value of the dollar. And as the dollar weakens, silver's appeal grows, but the timing is controlled. These shadow operators often use derivative contracts to amplify their influence. Futures, options, and ETFs all allow them to move the market without physically touching silver bars. That's why sometimes the paper market moves even when physical demand is steady. It's a sophisticated game of leverage and timing. Understanding these mechanics can make the difference between profit and loss. For investors, this means you can't just follow price charts blindly. You need to watch debt levels, Fed speeches, and the dollar index in real time. The gray ledger is showing you exactly why these signals matter. Because without that context, you're reacting to someone else's strategy. Let's talk about recent Fed moves. Over the past year, the Fed has been walking a tightrope. Inflation is stubborn, and economic growth is unpredictable. Every rate hike is measured, but every rate cut sends shockwaves. And shadow players in silver are ready for both scenarios. When rates rise, they know silver might dip temporarily. They buy the dips, controlling the recovery. When rates fall, they anticipate the spike and position themselves to benefit. This creates a market where price swings often precede headlines. Retail investors see the spike after the fact, thinking it was sudden news. But the gray ledger knows these patterns are calculated. Understanding these connections is actionable. You can align trades with macro trends instead of chasing random movements. For example, watching the US debt ceiling debates can reveal potential volatility windows. If the government nears borrowing limits, the Fed may act, and silver often reacts even before official statements. Timing matters more than ever in this environment. Shadow players exploit timing to maintain control. They also exploit the physical versus paper market difference. Physical silver is finite, but paper contracts can be leveraged endlessly. This allows operators to control sentiment even when real supply is tight. Investors need to be aware. A large paper sell-off can depress prices temporarily, but physical demand can reverse the trend quickly if shadow operators allow it. It's a delicate balance of perception and reality. The takeaway: knowledge is power. Watching debt levels, Fed signals, dollar trends, and market positioning gives you an edge. Understanding the shadow market allows you to anticipate swings rather than react. The gray ledger emphasizes that strategy starts with observation. Observe how silver responds to each Fed statement. Notice how price movements correlate with US debt announcements. Track the dollar index closely. This isn't about guessing, it's about connecting the dots. And once you see the pattern, you can make informed decisions that most investors miss. For actionable insight, start by noting key dates: Treasury auctions, Fed meetings, CPI releases. These are the moments shadow players use to position themselves. And with awareness, you can align your trades with the underlying currents instead of fighting them. Even small positions timed correctly can outperform larger, uninformed bets. This strategy is subtle but effective, and it's why the gray ledger exists, to give you the full picture others overlook. We're about connecting debt, Fed policy, the dollar, and shadow market activity into a coherent story. Because when you see the full story, decisions become clearer. It's not speculation, it's pattern recognition. And pattern recognition beats random guessing every single time. Stay with us, because next we'll dive into the real players behind the curtain. Who controls the market, why they act the way they do, and how small investors can navigate this complex system. This is where most channels stop reporting, but the Gray Ledger digs deeper. We'll break down the shadow war in silver with clarity, showing actionable steps for viewers. Because understanding control points is the key to protecting your assets and spotting opportunities. Now let's talk about the real players behind the silver market. These aren't your average investors. We're talking massive institutions, hedge funds, and even some global banks with access to insider-level information. They coordinate actions across multiple markets, not just silver. Silver becomes a tool in a much bigger strategy. Some call it a shadow war because most of it happens away from public eyes. They monitor the Fed US debt levels, inflation reports, and even political developments. Every move is calculated to influence market psychology. When the Fed hints at inflation control, these players adjust positions instantly. It's almost algorithmic, but backed by human decision-making. Retail investors often react too late, missing the trend. And that's the point. The game isn't about public awareness. It's about positioning. Some of these operators have been in the market for decades. They know patterns that most investors will never see. They can move billions with a single trade, and the ripple effects are enormous. You've probably noticed sudden silver spikes that defy logic. That's not coincidence. That's orchestration. And the Gray Ledger is here to break it down for you. We want you to understand why prices move before you see the news. Because once you grasp the patterns, you gain perspective. Let's tie this to Fed strategies. The Fed isn't acting in isolation. Every interest rate decision is influenced by debt pressures, inflation expectations, and political priorities. When they raise rates to curb inflation, shadow players in silver anticipate the market reaction. They might temporarily sell positions to avoid a dip, or they might buy small amounts quietly to benefit from a later spike. Conversely, when rates are cut, silver usually rallies. But the magnitude and timing are influenced by these operators. This is why watching just the price chart isn't enough. Understanding Fed communications like minutes and speeches is crucial. Shadow players act before the general public reacts, and that's where you can gain an edge. Even small investors can observe these patterns. Look for correlations between Treasury announcements, Fed moves, and dollar index changes. That's your roadmap. Now let's talk about the dollar. A weak dollar makes silver more appealing internationally. But shadow operators can manipulate sentiment to exaggerate price reactions. They may allow temporary dips or spikes to trigger retail buying or selling. These aren't random, they're psychological triggers. Understanding this allows you to time moves better. Don't chase price spikes blindly. Wait for alignment between the Fed's moves, dollar trends, and market positioning. This is how professionals manage risk. Even a modest position timed correctly can outperform riskier trades. The Gray Ledger emphasizes patience and observation. Knowledge isn't just power rights protection. Now actionable insight. Start tracking key economic events. CPI reports, unemployment data, Fed meetings, and debt auctions. These are moments when silver can experience significant moves. Notice how prices react before, during, and after these events. Patterns emerge over time, giving you an informed perspective. Next, consider shadow player influence on physical versus paper silver. Physical silver is limited, but paper markets allow leveraged positions. These players can move paper prices dramatically, even if physical demand is stable. Understanding the difference helps you anticipate reversals. This is critical when markets seem irrational. Sudden dips or spikes often reflect paper market activity, not physical demand. Recognizing this distinction protects investors from panic-driven mistakes. Timing matters more than ever. Small, strategic moves can outperform large, uninformed trades. And here's a key insight. Shadow players often act in cycles. Price dips, controlled recoveries, and sudden spikes follow predictable patterns tied to debt, Fed policy, and dollar behavior. The Gray Ledger encourages you to observe, not react. Because the market rewards those who understand the underlying mechanics, not those who chase headlines. And as we move further, we'll explore how to read these cycles and make practical decisions. We'll also expose how these shadow players protect their positions during turbulence. Understanding these methods gives you context for every sudden move in silver. From Fed rate signals to Treasury announcements to dollar fluctuations, it all connects. And the more you understand the connection, the less you're caught off guard. This isn't theory. It's practical insight into a market that's often opaque. By tracking these patterns, you can anticipate potential opportunities. You'll see moments when retail panic is likely, and when controlled movements suggest a larger trend. Even if you trade modestly, this knowledge gives you leverage over uninformed participants. The Gray Ledger provides this perspective to give you the full picture. Because when you see the shadow war for what it is, you stop being a bystander. You start making informed decisions, and those decisions compound over time more than chasing random swings ever could. Stay tuned, because Part 4 will reveal precise, actionable steps and strategies to navigate this shadow market effectively. We'll also cover how to position for the dollar's weakness and silver's potential spikes. Plus, we'll close with a powerful call to action that helps viewers like you comment, share, and engage with the channel. Now let's bring this together in practical terms. Understanding the shadow war is powerful, but strategy is what protects you. First, stop reacting emotionally to silver price spikes. When you see a sudden surge, pause. Ask yourself what the dollar is doing. Check Treasury yields. Look at recent Fed comments. If silver jumps while the dollar is weakening and yields are falling, that alignment matters. That's not random momentum. It's macro pressure building under the surface. Second, respect timing around Fed meetings. Volatility often increases before announcements. Shadow players position early. Retail traders usually move late. Instead of chasing headlines, prepare ahead of major economic events. Mark the calendar for Fed rate decisions, CPI releases, and major debt ceiling discussions. These are not just news days. They are positioning days. Third, understand the dollar index. The dollar shows sustained weakness over weeks, not just hours. Silver tends to respond stronger. Short-term dips can be engineered. Long-term trends are harder to fake. Focus on trends, not noise. Fourth, consider risk management. Never overextend in a volatile market controlled by powerful institutions. Even when the long-term outlook favors silver, timing still matters. Small, strategic entries outperform emotional all-in trades. Remember, shadow operators use leverage. You don't have to compete with their size. You compete with discipline. Now let's talk about debt. The US debt trajectory is unlikely to reverse overnight. Deficits continue. Interest payments rise. And the Fed must balance inflation control with economic stability. The tension creates opportunity in hard assets like silver. But it also creates engineered volatility. That's the battlefield. When debt expands aggressively, the dollar faces pressure. When the dollar weakens, silver gains structural support. But shadow players determine how smooth or chaotic that rise becomes. This is why patience is critical. You're not trying to outmuscle institutions. You're aligning with macro reality. And macro reality right now revolves around debt sustainability and monetary policy limits. The more debt accumulates, the more sensitive the system becomes to interest rates. And the more sensitive the system becomes, the more reactive markets become. Silver thrives in uncertainty, but only when you understand the source of that uncertainty. Here's a powerful mindset shift. Instead of asking, why did silver spike today? Start asking, what macro pressure forced this move? Was it debt? Was it the dollar? Was it a shift in Fed expectations? Patterns reveal themselves when you consistently ask better questions, and that's what the gray ledger is about. Clarity over noise. Strategy over emotion. Awareness over reaction. The silver shadow war isn't about conspiracy. It's about power, information, and positioning. Large institutions protect the stability of the broader financial system. Sometimes that means suppressing volatility. Sometimes that means allowing explosive moves. Your job isn't to fight the system. Your job is to read it, to observe where debt trends are heading, to watch how the Fed communicates under pressure, to track how the dollar behaves during stress. When those three align, silver rarely stays quiet. And when silver moves with macro alignment, the opportunity is stronger. Not guaranteed, but stronger. As we close this investigation, remember something important. Financial markets reward preparation. They punish impulse. The shadow players rely on emotional reactions from the public. Don't give them that advantage. Move with awareness. Move with patience. Move with a plan. If this breakdown helped you see the silver market differently, let us know. Drop your thoughts in the comments. Do you believe the dollar will weaken further this year? You think silver is being strategically controlled? Your perspective matters. Your insight helps this community grow stronger. If you found value in this episode of The Gray Ledger, share it with someone who needs to understand what's really happening beneath the surface. Because the more informed investors become, the harder it is for shadow control to go unnoticed. And of course, if you haven't already, subscribe and stay connected. We're just getting started uncovering the deeper layers of debt, Fed strategy, and market power. This is not financial advice. It's strategic awareness. And in a world shaped by rising debt, shifting policy, and a fragile dollar, awareness might be your greatest asset. Stay sharp, stay patient, and stay with the Gray Ledger.